Hey, welcome back, everybody. Today we are pulling back the curtain on Fidelity Cash Management Account, and we're gonna go right from the start here. Mention that this is not on a sponsored video. Nobody paid me to say nice things about Fidelity. I actually use Fidelity for one of my own retirement accounts, and I have personal experience with this platform. Now, what I want to do today is give you the honest breakdown and what most YouTube videos skip over. So the flashy stuff, sure, but also the parts that matter before you actually decide to use this organization with your hard earned money. Because here's the thing, your cash decisions are just as important as your investment decisions. Most people spend hours picking stocks, but only 5 minutes deciding where to park their emergency fund. And that gap costs real money every single year. So, whether you are completely new to Fidelity or you are already a customer trying to figure out if this account makes sense, stay with me because we're going to cover everything. All right, so this is the first thing that we need to understand, and that's the fact that the Fidelity Cash Management Account is technically not a bank account. And I know it looks like one. It has a debit card, it has bill pay, and you can write checks. And it feels like a checking account, but legally and structurally, it is a brokerage account. Now, think of it like this: a regular bank is a coffee shop that also sells pastries. Fidelity is a bakery that decided to also start selling coffee. The coffee is great, maybe even better than the coffee shop. The underlying business is different, and that difference matters when we start talking about how your money is protected, which we'll get into here very soon. Now, the reason Fidelity built it this way is actually to give you more flexibility and more earning potential than a traditional bank account offers. But you need to understand what you're actually working with before you hand over your direct deposit. This distinction will make a lot more sense in the next few slides. Okay, so now let's put this in very basic terms. I always like to break things up that are complex into very specific baby bite-sized steps so that way it's easy for me to understand. And that's exactly the philosophy I want to follow in this video. Now, let's say that you got $10,000 sitting in a big bank savings account, somewhere like maybe Chase or Bank of America. These are organizations that I talked about here on the channel a lot. Now, at their standard savings rate, you might earn somewhere around $1 to maybe $5 over the entire year. Meanwhile, that same bank is lending you money out at 7, 8, even 9% interest rates on car loans and credit cards. It's almost like letting somebody else borrow your car for a whole year and then giving you back the car only with a handful of quarters. Now, that is a deal most Americans have accepted without question in their regular savings accounts. And I am not here to make you angry. I am here to help you do something about that. All right. So, of course, there are better options available right now. And one of them is this Fidelity account. But here's what I also want you to know: Fidelity is not perfect either. And I will show you exactly where it'll fall short. Stick around because we are just getting started. Now, if you don't know anything about me, by the way, my name is Alex Isidro. I'm my dad, husband, engineer. And this channel is all about helping you build your wealth, protect your wealth. So if you find this video helpful, please give it a like, subscribe to the channel, and check the links in the description for helpful resources to grow your wealth. All right. So Fidelity has been around since 1946. That is almost 80 years ago. And to put that in perspective, they survived the Korean War, multiple stock market crashes, the dot-com bubble, the 2008 financial crisis, and even a global pandemic recently. So they're not a startup, right? That matters when you are trusting a company with your hard-earned money, especially when it's in the thousands, tens of thousands, even hundreds or millions of dollars. Now, the important thing to understand is that Fidelity is primarily an investing company. That's what they do. That's their core business. That's their DNA. We're talking about retirement accounts, brokerage accounts, health savings accounts, and that's just what they do. The cash management account is essentially their answer to the question, what do our customers do with the cash that is just sitting between investments? So they build something that looks and feels like a bank account, but lives inside their investment ecosystem. And that integration is actually one of the biggest advantages. Now, let's look at what actually makes their cash management account different from your regular checking and even savings account, high yield savings, that is. All right, so Fidelity makes a bold claim when they say that this account is an alternative to traditional banking that can pay you more. And to be fair, there is a real substance behind that claim, but also some nuance that you need to know. Now, three things stand out. The interest rates are generally higher than most checking accounts. Second, they reimburse ATM fees worldwide. That is a huge plus for people who are always on the road, traveling, Now, third, and this is the headline feature, they offer FDIC insurance up to $4 million. Now, if you compare that to the regular bank FDIC limit of $250,000, then of course, for most people, including myself, that is enough, right? But for many high earners out there, people who have a lot of time to accumulate the wealth, perhaps business owners, that extra coverage in FDIC is all the difference, and it's very, very significant. Now, I said that there's a nuance, and there is, because that $4 million number comes with some print that we need to unpack. And once we do, the picture becomes clear. So let us get into the actual mechanics. By the way, this number right here got updated since our last time we talked about Fidelity. This number is now 4 million. Why did it go down? I don't know. Okay, now this slide is straight from the Fidelity website, and I always encourage you to go and check the primary sources yourself. Don't just take my word for it, don't take somebody else's word. What you are seeing here is how Fidelity positions this account publicly. Notice the language, an alternative to traditional banking that can pay you more. That phrase, can pay you more, is doing some interesting work because it is true. It can. Whether it does depends on which option inside the account you choose. And we are about to break that down. So let's get right into that. Okay, so this is where it gets really interesting and where most people do not realize they even have a choice. Now, when your money sits in a Fidelity Cash Management account, it does not just sit there doing nothing. Fidelity gives you two options when you sign up and where your cash actually lives. Now, option one is the FDIC Insurance Deposit Sweep Program. Now, as of the date of this slide, that points 1.84% annually. Now, your money gets spread across multiple partner banks, which is how they get up to $4 million in FDIC coverage. Now, think of it like putting your eggs in several government insured baskets, and that's how it works. Now, option two, it's the one that is going to be more enticing here, and perhaps why it even caught your attention, and that is the government money market fund. Now, especially a fund called SPAXX or SPACs. Now, as of April 1st, 2026, that is paying 3.29%, nearly double the first option. Now, your money here is invested in extremely safe government debt. No stock market risk. We are talking loans to the US government. Now, the trade off is a slightly different type of protection. But for most people, the US money market option makes a lot more sense if earning more is the goal. Now, here's what you need to understand about each of these options and how they protect you. Now, let us first talk about what this account actually lets you do day to day, because honestly, it is pretty impressive for something that is not technically a bank. Now, you get a debit card, ATM fee reimbursements, check writing, bill pay, direct deposit, electronic fund transfers, automatic investments, and of course, overdraft protection through something called Cash Manager. Everything your checking account does, and then some. Right? The automatic investments feature is one that I particularly find useful because you can set it up so that when your balance goes above a certain threshold, Fidelity automatically moves that money or all that excess into an investment. Think of it like a smart piggy bank that knows when it is full and it starts putting the overflow to work. There's no maintenance fees, no minimum balance, no foreign transaction fees on a debit card. And I want you to think about how much you paid in bank fees, maybe even last year. ATM fees, monthly maintenance fees, overdraft charges. Now, for a lot of people, that number is surprisingly very high. Now, imagine the number just being zero, right? That is the starting point with Fidelity, but there are still some important layers that you need to understand in how your money is protected inside this account. Okay, so now this comparison table is the heart of the decision inside the Fidelity Cash Management Account. So let me walk you through it in very, very plain terms. Now, you essentially have two buckets for your cash once you sign up. Bucket one is the FDIC sweep, which we talked about a little earlier. It does have a little bit of a lower interest, currently 1.84%, but your money is covered by the federal government up to $4 million total across partner banks. There's zero risk of losing a single dollar within those limits. Now, bucket two is the money market fund called SPACs. It does have a higher interest at 3.29%, but the protection type is a little different. This one uses SIPC, which we are going to explain here in just a second. Plus, Fidelity adds an extra layer of their own coverage on top. Now, the practical question is, which one should you pick? Right now, for most regular people, someone with 10, 20, $50,000 in cash, the money market fund is likely the smarter play because you earn significantly more and the risk is very, very low. But if you are parking several $1 million and absolute government backed safety is your top priority, then the FDIC sweep has its place. So let me explain SIPC in simple terms so that this all going to click. Now, SIPC is the standard protection for brokerage accounts. Think of it like a FDIC for banks, but for brokers. Now, Fidelity goes beyond the standard coverage by providing additional protection on top. Now, the key detail highlighted here is that there is a per customer limit of $1.9 million specifically on cash that is waiting to be invested. So, if you have cash sitting in the money market fund inside your cash management account, you are covered by SIPC's standard limits first. Then Fidelity's additional $1.9 million layer kicks in if that gets exhausted. Now, there's an important caveat here because it does not cover investment losses from normal market swings. It only activates if Fidelity itself fails as a company. That is a very different and much, much rarer scenario. Now, next slide is going to show you the real world example of how this works. So, SIPC is actually one of those acronyms that sounds a little bit scary, but it's actually pretty straightforward. And honestly, it took me a little bit to understand this concept as well. So, I'm going to share it with you in the best way that I can. Think of it this way. Imagine you park your car in a valet lot. Now, SIPC is like insurance that kicks in if the entire valet company goes out of business and loses your car, not if someone digs your bumper in the parking lot. Very, very different. Now, it protects you from brokerage failure, not from normal market ups and downs. Now, specifically, it covers up to $500,000 in investments, things like stocks and bonds, and up to $250,000 in uninvested cash sitting in your account. So, if you have $100,000 in index funds and $20,000 in cash in your Fidelity account, and Fidelity somehow went bankrupt tomorrow, SIPC would work to get all of that back to you. Now, on the other hand, normal market losses, like if your index fund drops 20% in a bad year, that is completely separate. Now, SIPC does not help with that, and it was never designed to do so. So, how does this play out in a realistic scenario? Let me show you how that works. Now, let's say you got $10,000 invested in a total market index fund inside your Fidelity CMA, and $1,000 in uninvested cash also sitting there. Now, that is $11,000 total. Now, if Fidelity went bankrupt tomorrow, which, by the way, will be one of the most shocking financial events in American history, given how large and established this organization is, here is what the SIPC would do. Your $10,000 in securities, fully protected. Your $1,000 in cash, also fully protected. SIPC would work to transfer everything to another brokerage, and your total of $11,000 is nowhere near the $500,000 protection limit. So you would be made whole. Now, here's the honest nuance. This process is not instant. It can take time, but the money will come back to you. Now, for the vast majority of people, the SIPC limits are more than enough. The only people who need to think more carefully are folks with very large balances. And for them, the FDIC sweep option we discussed a little earlier might be the right call. Okay, so now let's go over the pros, what Fidelity does right. Now, the high insurance coverage is generally impressive between the FDIC sweep option up $4 million and the combination of SIPC plus Fidelity's excess coverage on the money market side. Most people's cash is extremely well protected. No other standard bank account comes close on the front. Now, the no fee structure is also a real win. I cannot stress this enough. There's no ATM fees anywhere in the world, no maintenance fees, no overdraft fees, no foreign transaction fees. Over a year, that could easily save you $50 to $200 depending on how you bank. And the investment integration is seamless. So if you decide to move money from your cash management account into a Fidelity brokerage or an individual retirement account, it happens almost instantly. There's no 2 to 3 transfer wait like you get moving money between separate banks. Now, everything lives under one roof. For investors, especially, that convenience has real value. But of course, it's not all sunshine and rainbows. Now, let's talk about the downsides of Fidelity. All right, so before we get into the cons, I wanted to share this here because in the past, I got comments from you guys and the viewers mentioning that Fidelity had a fee with foreign transaction fees and they took that away. That's what they mentioned on the website. There's no foreign transaction fees, and that's the latest on that end. Now, here are 3 things that Fidelity does not advertise on the big bold headlines. First is the interest rate. Now, even the better money market option at 3.29% is not always the highest available. Some high yield savings accounts right now are paying more, about 3.5%, 4%, even a little bit higher now in April 2026. If you have a $50,000 emergency fund, let's say, and you are earning 1% less than the best available rate, that is $500 a year, and you are leaving money on the table. Now, second, some customers have reported that transfers out of the account can take longer than expected, particularly when moving money to an external account. Now, internal Fidelity transfers are fast, but going outside the ecosystem to other organizations, you can occasionally take 2 to 3 business days or even up to 2 weeks. Now, third, and this is a practical one, you cannot deposit cash, right? There's no way to walk up to a Fidelity branch, although they do have branches they call investor centers. But of course, you do have to live near one, which, let's be honest, most people don't just live near a Fidelity branch, right? They're all over the world or all over the United States. Now, so if you regularly receive cash, maybe from a side gig or a small business, you would need a traditional bank account for that first step. Now, none of these are deal breakers in my personal opinion for most people, but they matter depending on how you actually use your banking needs and your money day to day. So with that being said, of course, let's go on who is this account for. Now, let me give you a very simple filter for whether this account makes sense for your life right now. Now, think about three types of people. First, the active investor, somebody who already has or is building a Fidelity brokerage or retirement account. Now, for that person, having a cash management account with Fidelity specifically is almost a no brainer, right? Because moving money between accounts is seamless and very fast. Now, second, the frequent traveler, somebody who hits an ATM in different countries a few times a year, that worldwide fee reimbursement and zero foreign transaction fees make this generally valuable. And third, the high net worth individual. Now, somebody with more than, let's say, $100,000 to $250,000 and liquid cash who needs coverage beyond the standard FDIC limit. There are ways that you can increase this FDIC insurance regardless of what bank you are using. But for simplicity purposes, the $4 million FDIC insurance by Fidelity or the layer SIPC protection makes Fidelity stand out for sure. So, who is this not for? If your number one priority is earning the absolute highest interest rate on your savings, there may be a better suited account for that specific job. And I am not leaving you hanging on this because the smartest strategy is not necessarily choosing between Fidelity or something else. It might be using both, right? Fidelity with another higher earning interest rate. And that's exactly where we're going to cover next. Because here's the financial move that many people overlook, and it's actually simpler than you think. You could use Fidelity for what it does best, which is handling the liquidity, no fees, investment integration, and a strong protection, essentially like a supercharged checking account. And you could park your true savings, your emergency fund, your house down payment savings, your medium term cash goals in a high yield savings account that is currently paying more than Fidelity. Now, right now, the top high yield savings accounts in the market are paying somewhere around 3.5, 4, even more than 4% in some cases, depending on the institution. Now, compare that to the 1.84% on the Fidelity FDIC sweep option, and the difference on a $20,000 emergency fund is about $400 to $600 per year. Of course, that adds up very quickly and it is meaningful. So think of it like having two wallets, right? One wallet for the Fidelity Cash Management Account. That's your everyday wallet. That's your supercharged checking account, liquid, accessible, fee-free, connected to your investments. The other wallet is your savings engine, and that is sitting in a high-yield savings account, quietly earning while you sleep. They work together. You do not have to choose one and abandon the other. That combined approach is how professionals optimize their cash without sacrificing convenience or safety. So, if you're interested in opening an account with Fidelity, use the links in the description. If you also want to open a high yield savings account, I am going to leave my top recommendations and top picks in the description as well. With that being said, thank you guys for being here. I appreciate you, and I'll see you guys on the next one. Take care. Peace.